Today, falling, and the phony war. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 2nd of February 2019, our digest of the latest finance and property news with a distinctively Australian flavour. As we wait for the public release of the Royal Commission Banking Report on Monday, the slew of local data is pretty consistently underscoring the risks to the downside. And probably more home price falls ahead, as the pollies tried to position around a future credit supply. At least it seems that they now accept that credit supply drives home prices. And internationally, as growth slows, we see more signs of another round of low interest rates and quantitative easing emerging. And so I see this as the calm before the storm, or the phony war. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or by joining our Patreon program. Again, here is the link. We really appreciate those who are contributing to help us continue to make great content. And the links are also in the comments below. So first, we look at Australian home price movements, which according to CoreLogic's Home Value Index fell heavily in January, having fallen by the most since 1983 in December. This time the weakness was not just driven by falls in Sydney and Melbourne, and the losses last month were spread across the nation, falling in all capital cities except for Canberra and in some regional centres. The declines were almost everywhere, down another 1% during the month, so extending the national downturn that began in late 2017 to 6.1%. Australia's median home price now sits at levels not seen since October 2016, with prices declining in 13 of the past 15 months. Price declines range from 1.6% in Melbourne to 0.2% in Hobart, leaving the falls across the combined capitals at 1.2%. And that decline follows a 1.3% drop in December. So there is little sign that this downturn is slowing in early 2019. In fact, house prices fell across the capitals by 1.2% from December, led by falls of 1.7% and 1.4% and 1.1% respectively in Melbourne, Sydney and Perth. For apartments, capital city prices eased by a slightly smaller 1.1%, again driven by declines of over 1% in Melbourne, Sydney and Perth, along with a chunky 3.1% drop in Darwin. In regional areas, house and apartment prices both fell by 0.2%. And in the past 3 months, median prices in Sydney and Melbourne fell 4.5% and 4% respectively, the fastest pace at any point in the current downturn. Combined with more modest declines in Brisbane, Adelaide, Perth and Darwin, that left Australia's median capital city home price down 3.3% over the past 3 months, extending the decline over the past year to 6.9%. And the latter figure largely reflects falls of 9.7% and 8.3% respectively in Sydney and Melbourne since January last year. And Sydney prices are now back to where they were in July 2016. While those in Melbourne sit at levels last seen in January 2017. Sydney and Melbourne, of course, contain around 40% of Australia's total housing stock and accounts for around 55% of the nation's total housing wealth. So that makes movements in those cities highly influential on the national figure. In regional centres, median prices fell by a more modest 0.6% over the past 3 months and by 0.8% over the past year. And CoreLogic says weakness across the most expensive quarter of the market is most visible in Melbourne, where values have fallen 12.4% over the past 12 months and 13.8% since peaking. Sydney's top quartile is showing a similar trend, with values down 10.8% over the past year and 14.6% since they peaked. And over the past year, capital's home values in the top quartile of valuations have fallen 9.9%, faster than the broader capital city average over the same period. And median prices at lower quarters of the valuations have generally fared better across the smaller capitals, although they have still declined in Sydney and Melbourne over the past year. And I have to underline again that these are average numbers, and within the data that we see, there are significant areas now where prices have dropped more than 20% from their peaks, and that is now creating significant issues with regard to negative equity, as you'll see if you watch 60 Minutes tomorrow. Of course, credit availability is the key. So see our post, The Art of Credit Creation. As credit continues to tighten, so prices will fall. But it's worth underscoring the tighter conditions are merely reflecting the responsible lending rules, which were being broken by lenders in spades until recently. Household expenditure measures, or HEM benchmarks, were set way too low, allowing people to get loans they can never repay, and often on an interest-only basis. Rules are tighter now, thanks to the Royal Commission and APRA's belated interventions, but housing credit is still growing faster than wages or inflation, so household debt ratios will still rise further. Any call to release the taps is a call to encourage illegal behaviour. I will be interested to see the Commission's final view on whether HEM is banned or adjusted up as a backstop. But I don't expect credit growth to magically pick up. Of course, the report was handed to the Treasurer on Friday with no handshake, I might add, and David Rowe, the cartoonist, summed it up all rather well. Monday, 1610, is the public release, and of course we'll discuss the results as soon as they come out. As we discussed in our show, credit growth is slowing but still reaches another new record. The latest RBA and APRA credit stats show owner-occupied housing debt is still rising at an amazing 6.5% annualised, and all housing is still growing at 4.7%. In fact, we see the growth being driven by the less regulated non-bank sector, which grew at an estimated 16% last year, and smaller banks. However, even at these still elevated levels, the so-called credit impulse, the rate of change of credit growth, is slowing. And as ANZ said, this housing credit impulse fell to fresh cyclical lows in December, which points to the likelihood of further price weakness ahead. ANZ concluded this is consistent with our view that house prices will continue to decline through 2019. Now, of course, the debate has become political, with Treasurer Josh Frydenberg conceding that the Banking Royal Commission contributed to a credit squeeze, with the big banks less likely to loan money for home mortgages and small businesses. But the Treasurer warned that ensuring that Australians still had access to affordable credit was also vital to the economy. The Royal Commission has had an impact, I think, in terms of how banks have approached finance, he told the New Daily. In an opinion piece penned for the Australian Financial Review this week, Westpac boss Brian Hartzer dismissed suggestions that the Royal Commission had made banks scared to lend. Let's be clear, we want to lend, wrote Hartzer. However, he also revealed that now Westpac borrowers are subject to scrutiny across 13 categories of expenses before they can get a loan. And in the meantime, the panic builds around the credit squeeze. At the Australian, Small Business Ombudsman Kate Carnell has called on the Kane Royal Commission, policymakers and regulators to work harder to get small and medium businesses on a firmer footing against the banks or risk a credit squeeze in the $300 billion sector. Ms Carnell said despite the Royal Commission, the banks were still shying away from making real commitments to small business customers, including in their revised Code of Conduct, which gave them lots of get-out clauses. And Chris Joy in the AFR went all-out political this week, saying if Prime Minister Scott Morrison pulls off a miracle and wins the May election, housing conditions should stabilise as investors pile back into the market to pick up cheap assets once the threat of Labour's tax changes is removed. He said, I also expect the accessibility of credit to improve following the Royal Commission, which has wasted time questioning residential lending practices that are among the most conservative in the world, judged on the basis of Australia's mortgage default rates over the last 30 years. notwithstanding that our home loan rates have been lofty by global standards. If, on the other hand, Labour prevails, our extant forecast of a housing drawdown of up to 15% stands, with values in cities such as Sydney likely to fall more than 20%. I think this typifies the political spat ahead, where Labour will be teed up as the party to crash home prices further, while the incumbents will miraculously open the credit taps and lift prices higher. I don't believe this political phony war. Not only would this be irresponsible, as debt is too high a burden at the moment, lending standards need to be adhered to. And the broader negative impacts of the slowing housing sector are already biting and will continue to bite. Oh, and by the way, if you look at past crashes around the world, in every case, defaults for mortgages were very, very low until they weren't, as this chart shows. Now, turning to UBS, they say that home sales collapsed to a 21-year low, which is very negative for renovations and consumption. Home sales declined further, slumping to near the lowest level in 21 years. The pace of falls accelerated from a trend of around 10% year on year to a drop of around 16% now, and the turnover rate, sales divided by stock, collapsed to a record low recently. This is a very negative lead indicator for the renovations market and housing-related consumption. And the UBS credit tightening thesis is playing out, they say, with accelerating weakness in home prices, sales approvals and credit growth. The peak-to-trough decline in home prices is still in 6%, and we've long expected a 10% drop or more if regulators don't ease. But now that APRA has effectively ruled out further macroprudential easing, the risks of an even larger fall has increased. If there is a policymaker desire to support housing, given increasing evidence of a negative spillover to the rest of the economy, it would need to cut via the RBA cutting the cash rate. And this week, as UBS said, we got confirmation from APRA that they will not loosen the credit rules, keeping the floor rate at 7% and warning that, quote, many of the underlying structural risks associated with high housing debt remain and will do so for some time. Too true. We have had a credit-driven boom for a generation, and now the tide is turning. The credit taps are just not going to be opened further, as now bankers are on notice of the legal and financial consequences of bad lending. Indeed, it is possible the Royal Commission will recommend some criminal proceedings, but we will see. Meantime, the broader economic outlook is weakening in Australia. The ABS reports that the Consumer Price Index rose 0.5% in the December quarter 2018, which follows a rise of 0.4% in the September quarter. This means that inflation on the official measures remains below the RBA's target range of 2 to 3% at 1.8% and may suggest more of a bias towards cutting the cash rate, as we've been suggesting for some time. Of course, the official figures bear little resemblance to the real lived experience of many households, and the rental proxy for housing in the figures is underestimating the real expense of many with mortgages. In fact, one reason why the RBA policy levers look pretty sick is the fact that true inflation in real households is closer to 3.5% on average, and for some even higher. They have dropped the cash rate too far and now cannot recover. But as Damien Boy at Credit Suisse put it, CPI, unemployment and RBA forecast downgrades are becoming old news. The consensus view is that the RBA will moderately downgrade its forecast, but not capitulate on its rate stance next Tuesday. On the RBA's narrow list of criteria for setting rates, the economy is evolving within its desired parameters. The unemployment rate is at a cyclical low of 5% as forecast, and CPI inflation is around 1.75% also as forecast. And we also know that in the low era, the bank is more macroprudentially minded than not. Therefore, it is willing to suffer growth and inflation undershoots for the sake of not cutting rates and not inflaming the housing debt situation. In the extreme, this means that even if GDP growth were to slow to 1 to 2% and inflation follows suit, the bank would not cut rates. Now they say, looking at the data, there are reasons to be concerned, even for the hawks at the RBA. Real GDP only grew by 0.3% in the third quarter, and in the fourth quarter, things look worse. Net exports could subtract 0.5 to 0.8% from GDP growth, and residential investment likely fell. Infrastructure spending probably plateaued at a high level. Consensus is looking for 0.7% real retail sales growth, but this assumes something very generous for December, when we already know from higher frequency data that spending was weak. For example, the NAD cashless retail index maps to a 0.3% contraction in nominal retail sales, while vehicle sales plummeted over the month. In lieu of all these data points, if fourth quarter can repeat third quarter's performance on the back of industry build and other miscellaneous spending, this will be a very good outcome. But even so, two-quarter annualized growth will only be running at 1.2%, well short of the RBA's forecasts. Slower growth leads to slower inflation, and slower inflation leads to real higher borrowing costs, even before we factor in out-of-cycle rate hikes. So financial conditions are tight, and possibly tightening in the absence of intervention. At some point, they say, the money market will compel the RBA to cut, probably, though not yet. But the pricing is becoming too dovish to ignore, and they expect the dovishness to continue as Australian yields fall relative to US yields, which themselves are now falling on a more dovish Fed. And Morgan Stanley said, "We've removed rate hikes from our 2020 outlook as our AlphaWise research points to fragilities in the household sector and a more prolonged consumer adjustment. Weakness in the household consumer sectors should continue through 2019, and we think further forecast downgrades from the RBA and the adoption of an easing bias is likely. Offsets elsewhere in the economy, especially government sector, should help absorb some spare capacity and see only a moderate rise in joblessness, which would leave the RBA comfortable holding rates." But the latest from Westpac's Red Book shows that the sub-indices tracking views on family finances and time to buy a major item, both easing down 2.4% from 90.7 in October to 88.5 in January, the lowest read since September 2017. The index remains a long way below its long-run average, down 14 points, and is pointing to a per capita spending fall of about 1% a year. With population growth at 1.6% a year, that implies aggregate spending growth of just below 0.5% per annum, well below the current 2.5%. Plus, the third quarter national accounts provided another weak update on the consumer spending, undershooting expectations, real disposable income essentially flat, and a further decline in new sales, pointing to vulnerability going forwards. Weak incomes meant that the rise in spending was again partially funded by lower savings, the savings rate falling from an upwardly revised 2.8% in the second quarter to 2.4% in the third quarter, a post-GFC low. This highlights clear vulnerabilities going forwards, given risks around potential wealth effects. And anecdotes suggest Christmas sales were weak, with consumer sector responses to the NAB business surveys also showing a sharp weakening late in the year. Overall developments over the last 3 months have prompted Westpac to mark down their 2019 and 2020 forecasts for growth in consumer spending from 2.8% per year to 2.4% per year, and downside risks continue to dominate. And elsewhere, Westpac said the September quarter GDP report has disrupted the RBA's comfortable position on the growth outlook. With growth only printing 0.3% in that quarter, it will be necessary for the December quarter to print 1.2% to achieve the November forecast of 3.5%. The 2018 growth forecast is likely to be lowered from 3.5% to 3%. But what will that mean for the 2019 and 2020 forecasts? We know that the bank has assessed a minimal wealth effect on consumption, and the Q3 growth report is unlikely to have changed that view. Even further negative evidence on house prices in Sydney and Melbourne is unlikely to change the quantitative assessment that the wealth effect was minimal, while house prices were booming and therefore will be minimal in reverse. RBA Director Harper recently played down any evidence of a wealth effect in an interview with Dow Jones late last week. And developers are feeling the pinch. As The Australian reported, it may be as bad as last year, it may be worse, developer High-Rise Harry said of the outlook for 2019. While foreign buyers were returning, it was only in small numbers and Australian buyers were staying away. It must affect the broader economy, and he called on government to relax the foreign buyer taxes in a bid to revitalise the housing and construction sectors. He also called for early access to superannuation to allow younger people to buy a home. Well, we don't agree with that. And finally, research house Endeavour downgraded their outlook for residential property in 2019 and are expecting peak-to-trough falls of 25 to 30%, the worst since 1890. They expect a drop of between 10 and 15% in 2019, in addition to falls of around 15% in 2018. This means 2014 vintages will see significant losses, while many from 2015, 16 and 17 will experience negative equity. They say, "We expect a continuation of the 2018 credit crunch well into 2019 as the HEM non-prime bubble busts due to the combined impact of, firstly, real expenses shifting sharply towards an ABS/HES survey reality, and two, amortization of interest-only loans. Together, these impacts are expected to hit loan borrowing sizes for aggressively geared borrowers by 46% or more, savaging borrowing capacity for the marginal price setter of housing in the boom to 2016. The size of the credit crunch is directly proportional to the unreasonableness of the HEM expense benchmarks. Since HEM expense estimates are unreasonably low, the credit crunch will be significant and ongoing as it is increasingly replaced with reasonable expenses that are consistent with responsible lending laws. The median borrower on a household income of $140,000 HEM understated expenses by $48,000 per annum, leading to loan sizes of 30% plus, or $380K larger than if the HES-based survey expenses was used. For the median debt, which is owned by households on $180,000, the underestimate of expenses is considerably larger, up to a total of $80,000. This led to loan sizes $640,000 larger than if the HES expenses had been used. And failure to amortize interest-only loans over the non-interest-only period in serviceability calculators has also inflated loan sizes 20 to 30%. So in summary, a challenging environment for banks as credit slumps hit volumes and arrears rise, and that will drive home price falls further and create negative equity. And talking of negative equity, watch the latest edition of Nine's 60 Minutes, which will air on Sunday, and which updates our research and price expectations. Here is a preview where I discuss the latest with Ross Greenwood. 40% falls, anyone?
Martin, the last time you spoke with 60 Minutes, you predicted in a worst-case scenario that property prices across Australia could fall by as much as 40%. Looking back, do you think that was extreme?
No. I still think that we could see 40% plus falls over 2-3 years, you know. But this is a symbol of something much broader, that we have so many properties across Australia which are being thrown up or have been thrown up with significant defects in them. I think we've built a generation of properties that frankly could become slums in 20 or 30 years, and that's a very significant issue, not just for those individuals but for the broader economy.
If these people, in the dark blue areas in particular, had to sell tomorrow, they would get less for their house than what they owe to the bank.
Yeah, you'd still owe the bank if you tried to sell. And that's a big deal. And so to the markets. Locally, the ASX 100 ended at 4,832 on Friday, down 2.65% compared with a year ago. The local volatility index was 13.8 on Friday and up 11.7% compared with a year ago, so still relatively elevated. The S&P Financials Index was down a little to 5,545 and down 14.4% compared with a year ago. The Hain effect is clearly visible, plus concerns about international funding costs as shown by the still elevated BBSW rates. And of course, this week more banks lifted mortgage rates in response, including ING and ME Bank, and expect more to follow NAB's lead. ANZ ended down 0.4% to 24.93, 12.84% lower than a year ago. CBA dropped 0.21% to 69.76, down 11.27% from this time last year. And NAB fell 0.29% to 23.79, down 18.73% from a year back. And Westpac was up 0.12% to 24.58, but down 20.82% from a year ago. Westpac, of course, has the largest share of investor mortgages on their book and are in dispute with ASIC over the use of HEM. Among the regional banks, Bank of Queensland was up 0.59% to 10.23, but down 17.76% from last year. Suncorp was up 1% to 13.11 and down just 4.32% over the last year. And Bendigo and Adelaide Bank was flat at 10.78 but down 7.69% over the year. And AMP, who may be expected to get a copping from the Commissioner's final report, was down 0.88% to 224, down a massive 56.57% since the crisis. Macquarie was down just a little to 116.41, but up 13.03% from this time last year, while lender's mortgage insurer Genworth was down 0.45% to 221, down 23.54% over the past year, and aggregator Mortgage Choice was up 3.52% to 103, but still down 57.53% over the year. It'll be interesting to see how prices react to the release on Monday. We suspect that many will have gone short. The Aussie reacted to the Fed's change of direction in terms of rate policy and ended up 0.05% on Friday to 72.53, which is still 9.9% lower than a year ago. We still suspect the rate will drop as the local economy weakens. The Aussie Gold Cross rate was 1,817, which is up 8.94% from this time last year, and the Aussie Bitcoin Cross was up 0.38% on Friday to 4,395, but down 64.96% from a year ago. And so now to the US market. The Dow racked up its sixth weekly gain on Friday after data showed that the US economy created more jobs than expected last month. But Amazon's tumble back into bear market territory kept a lid on gains. The Dow Jones Industrial Average rose 0.26% to end at 25,063, down 4.4% from this time last year. The S&P 500 closed flat at 2,706 and is 4.2% lower than last year at this time, while the S&P 100 ended at 1,191, down 4.77% on last year. The Volatility Index was down 2.6% to 1614, still up 22.38% on last year, and the S&P Financials Index was up 1.73% on the day to 431.73 and down 12.5% on last year. And Fitch pointed out that a spike in market volatility during the fourth quarter 2018 dragged down overall capital market results for the 5 major US trading banks, as total debt underwriting revenues fell 24% from the year ago, reflecting volatility, particularly impacting the high yield market. Goldman Sachs fell 0.74% on Friday to 196.54 and is 26.09% down compared with a year ago, reflecting a range of elevated risks. The Nasdaq Composite slipped 0.25% to 7,263, down just 1.75% on a year back, and in fact, this is the 6th straight week ending higher, beating the S&P 500's 5th in 6 weeks. The US economy created 304,000 jobs in January, up from 222,000 the prior month. That was above economists' forecasts of 165,000 and comes after the longest government shutdown in US history, which seemingly had a muted impact on job growth. Wage growth, meanwhile, slowed to 0.1%, below expectations for a 0.3% rise, and the unemployment rate unexpectedly ticked higher to 4%, from 3.9% in December. The stronger jobs report helped limit the impact from weakness in consumer discretionary stocks, led by Amazon, which fell 5.34% on Friday to 1,626 and is up 18.46% from the year prior. Its upbeat fourth quarter results were undone by concerns raised during its earnings call with investors. A bear market is usually defined as dropping 20% from a recent high, and in late December the shares were down as much as 36% from their 52-week high. Gains since December the 24th had trimmed that decline to less than 20% on Wednesday. The shares are now down 20.7%. The e-commerce giant said it would likely increase investment in 2019 and raise concerns about new regulation in India. Apple was up a little to end Friday at 166.52, down just slightly over the year. Google's Alphabet was down 0.65% to 1,168 and down 4.76% from 12 months ago. Facebook ended at 165.71, down 10.81% over the year, but Intel rose 3.42% to 48.73 and is 2.12% down over the year. The US Federal Reserve kept rates on hold this week and underscored its patience in terms of future movements, which is central bank speak, suggesting that the current tightening cycle has ended for now. Plus, we suspect the rate of quantitative tightening will slow too, providing more support to the US economy. They are prepared to QE again if needed. The net result will be for more positive market movements for now. They also reaffirmed inflation targeting is the core principle behind their management approach, and you can watch our post, The Fed Blinks, where we discuss the implications. As a result of this, the US 10-year bond rose 1.87% on Friday to 2.684, while the 3-month ended at 2.40. Rates are likely to stay in these ranges in the months ahead, given the weaker, some would say capitulated, Fed. There was little change on the US dollar index at 95.61, though it was 7.21% higher than a year ago. And trade talks with China are evidently still in train, despite the threat of an escalation by the US in a month if there is no structural agreement. And in Europe, the Brexit ructions continue. The British pound US dollar rate ended at 1.309, still down 7.67% on 12 months back. And the FTSE was up 0.74% to 7,020 and is also down 7.5% across the year. The FTSE Financial Services Index was up 0.59% to 649.99, down 6.77% on a year back. And the euro US dollar was up just a little to 1.1457, down 7.87% on a year ago. And Deutsche Bank was back below 8 at 7.58 and is 47.01% down on a year back. They reported net losses of 409 million euros in the fourth quarter 2018, compared with a loss of 2.4 billion euros in the year ago quarter. The bank incurred losses before taxes of 313 million euros. Lower revenues and higher provisions were the key undermining factors. Noticeably, net asset outflows were recorded during the quarter. However, strong capital positions and lower expenses were the main positives. Considering the progress made in 2018, management lowered 2019 adjusted cost targets to 21.8 billion euros from previously 22 billion euros. And also, the bank reaffirmed its target to reduce the internal workforce to below 90,000 by the end of 2019. Additionally, Deutsche Bank reaffirmed its commitment to its plans to achieve a post-tax return on tangible equity target of more than 4% in 2019. Though Deutsche Bank's restructuring efforts look encouraging, it is really difficult to determine how much the bank will gain considering the lingering headwinds. Moreover, dismal revenue performance remains another concern. The euro and US dollar was down 0.65% to 0.1483 and is down 6.29% compared with a year back, but there was more weakness reported in the Chinese economy and an expectation of more stimulus down the track. The energy sector, meanwhile, served up impressive gains as oil prices settled sharply higher, following a fall in rig counts and signs that the US sanctions on Venezuelan exports had trimmed supply, with the WTI futures was 2.88% higher on Friday to 55.34, though still 16.44% lower than a year back. Gold was down 0.23% to 1,322 and down 1.07% across the year. Silver ended down 1% to 1591, down 6.78% from a year back, and copper fell 0.48% to 277, down 12.75% from a year ago. The Bitcoin dollar rate was 3,539, up 0.83% on the day, but still down a massive 66.07% from a year back. Just over a week ago, the Van Eyck Solex proposal to list a Bitcoin exchange-traded fund, an ETF, on the CBOE was withdrawn from regulatory consideration by the exchange's parent CBOE Global Markets. It was the most recent blow to crypto investors hoping to gain greater legitimacy for the currently bearish asset class and garner additional uptake from conventional investors looking for a less volatile, lower risk way to invest in digital currencies. Earlier attempts at similar funds have met with failure over the past few years, even when the US government was fully operational. And the US Securities and Exchanges Commission, the SEC, is proving to be at the major hurdle to the introduction of such a fund, having already rejected 9 other applications since 2017. The SEC's concerns primarily centre on issues of market manipulation, surveillance, and infrastructure. And so, standing back and in summary, risks are on the downside, and we are going to see more attempts to talk the economy higher before rates are cut and money is printed. We are in for the phony war for now. If you like what you've seen here today, please share the post and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting that subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.